Now, I will explain about the business nature of Dutch Lady Milk Industrie Berhad. Dutch Lady Milk Industrie Berhad, or DLMI, is a leading dairy company in Malaysia with more than 16 years of experience. The company is part of Royal Friesland Campina, a global dairy cooperative. DLMI produce and distribute dairy products such as liquid milk, UST milk, flavored milk, and growing up milk formula. The company focuses strongly on nutrition, product quality, and food safety. DLMI also use Industry Revolution 4.0 technology in its production process to improve efficiency and quality. In addition, the company supports local dairy farmers and practice sustainable and responsible business operation. That's all for the introduction of Dutch Dairy Milk Industrie Berhad.
Good day everyone, my name is Tanushini Murugan. My metric number is A24A3255. Today I will be discussing the liquidity position of Dutch Lady and Nestle by focusing on their current ratio over the 3-year period from 2022 to 2024. Firstly, looking at Dutch Lady, the company current ratio declined from 1.12 in 2022 to 0.80 in 2023. Before showing a slight improvement to 0.84 in 2024, this trend indicates that while Dutch Lady experienced some recovery toward the end of the period, its ability to meet short-term obligations using current assets remained below the generally accepted healthy benchmark of 1.0 throughout the 3-year. A ratio below 1.0 suggested potential pressure on short-term liquidity as current liability exceed current assets. In comparison, Nestle current ratio showed a consistent downward trend, falling from 0.71 in 2022 to 0.61 in 2023 and further declining to 0.55 in 2024. This continuous deterioration reflects a weakening short-term liquidity position, indicating increasing reliance on efficient cash flow management on external finance to meet short-term commitment. When comparing both companies, Dutch Lady demonstrates a relatively stronger liquidity position than Nestle across all 3 years. Despite both operating below the optional current ratio level, this suggests that while neither company maintains ideal liquidity, Dutch Lady is better positioned to handle short-term liability. Now, I will explain the quick ratio of Dutch Lady and Nestle. The quick ratio measures a company's ability to pay its short-term debt using only its most liquid assets, such as cash and receivable, without relying on inventory. First, looking at Dutch Lady, its quick ratio dropped sharply from 0.59 in 2022 to 0.32 in 2023. This shows that the company's immediate liquidity position became much weaker in 2023. In 2024, the ratio improved slightly to 0.37, but it was still far below the ideal level of 1.0. This means that during all 3 years, Dutch Lady had difficulty paying its short-term obligation using only its most liquid assets. In comparison, Nestle quick ratio stayed low but stable over the 3 years. The ratio was 0.21 in 2022. The ratio increased slightly to 0.22 in 2023 and then decreased to 0.20 in 2024. This shows that Nestle also faced ongoing challenges in meeting its short-term liability from its more liquid assets.
I am Sumitra Vasu, my metric number 824-83803. Today, I would like to present about profitability ratio. First, gross profit margin from 2022 until 2024. Between 2022 and 2024, both Dutch Lady and Nestle improved their gross profit margins. Nestle led in 2022 and 2023, reflecting stronger cost control and effective pricing strategies. However, in 2024, Dutch Lady overtook Nestle, likely due to better cost management or product optimization. Overall, this trend highlights Dutch Lady rising profitability and its growing competitive advantage in the market. Next, net profit margin. From 2022 to 2024, Dutch Lady net profit margin steadily increased from around 3.5% to 6.5%, showing improved profitability. In comparison, Nestle margins stayed near 9% in 2022 and 2023, but declined to 6.5% in 2024. As a result, both companies reached the same margin by 2024, highlighting Dutch Lady progress and Nestle's slowdown in profitability.
Now, I will explain the return of assets of ROA for Dutch Lady and Nestle from 2022 to 2024. ROA shows how well a company uses its asset to generate profit. Starting with Dutch Lady, ROA improves steadily over the 3 years. In 2022, the ROA was 5% and it's increased to around 9% by 2024. This shows that Dutch Lady become more efficient in using its asset to earn profit, which reflects stronger business performance. In comparison, Nestle recorded a much higher ROA in the earlier year. Its ROA was around 18% in 2022 and 2023, showing very strong asset efficiency. However, in 2024, Nestle ROA dropped to about 12%, indicating a decrease in how efficiently the company uses its asset. Overall, while Nestle still had a higher ROA, the difference between the two companies became much smaller by 2024. This shows that Dutch Lady performance is improving while Nestle experienced a decline in asset efficiency. Next, I will talk about the return of equity or ROE from Dutch Lady and Nestle from 2022 to 2024. ROE show how well a company uses shareholders' money to make profit. For Dutch Lady, the ROE increased steadily over the 3 years. It rose from just over 10% in 2022 to almost 20% in 2024. This showed that Dutch Lady became better at using its shareholders' funds to generate profit and give better returns to investors. In comparison, Nestle recorded very high ROE value. Its ROE was close to 100% in 2022 and 2023 before dropping to around 75% in 2024. Although the ROE declined, Nestle still performed much better than Dutch Lady. Overall, while Nestle continued to have higher ROE, the gap between the two companies becomes smaller. This shows that Dutch Lady is improving its efficiency, providing better return to shareholders.
Hi, my name is Lakshmi Ganesan. My metric number is 824-83537. Today I'm going to talk about the inventory turnover ratios of Dutch Lady and Nestle. It shows contrasting trends from 2022 to 2024. Dutch Lady recorded its highest inventory turnover in 2022 at 4.32 times, but this figure gradually declined to 4.21 times in 2023 and 4.04 times in 2024. This indicates a decrease in inventory management efficiency over time, as inventory was converted into sales less frequently. In contrast, Nestle demonstrated stronger performance. Its inventory turns increased from 4.13 times in 2022 to peak of 5.66 times in 2023, before slightly declining to 5.22 times in 2024. Overall, Nestle made a higher inventory turnover throughout the period, reflecting more efficiency, inventory control, and stronger sales efficiency compared to Dutch Lady. Next, I'm going to talk about the average receivable turnover ratios. It shows difference in credit collection efficiency between Dutch Lady and Nestle from 2022 to 2024. Dutch Lady's receivable turnover increased from 13.71 times in 2022 to a peak of 15.29 times in 2023, before declining to 11.78 times in 2024, indicating the most efficiency collection in 2023. Nestle recorded a receivable turnover of 14.97 times in 2022 and which dropped sharply to 8.48 times in 2023 before recovering to 14.36 times in 2024. Overall, Dutch Lady shows more consistent receivable management while Nestle experienced greater fluctuation over the period. Last but not least, I'm going to talk about the total asset turnover ratios. The total asset turnover ratio shows how efficiently Dutch Lady and Nestle used their asset to generate sales from 2022 to 2024. Dutch Lady ratios declined from 1.59 times in 2022 to 1.52 times in 2023 and 1.35 times in 2024, indicating that 2022 was the most efficient year. In comparison, Nestle's total asset turnover increased from 1.88 times in 2022 to a peak of 1.98 times in 2023 before falling to 1.71 times in 2024. Overall, Nestle shows higher asset utilization efficiency more than Dutch Lady throughout the period.
The debt ratio shows how much of a company assets are financed by debt. For Dutch Lady, the debt ratio decreased cleanly from 0.56 times in 2022 to 0.53 times in 2024, indicating a reduction in debt repayments and better financial stability. In contrast, Nestle recorded a higher debt ratio throughout the period, increasing to 0.85 times in 2024, which shows greater reliance of borrowed funds. Overall, Dutch Lady has more conservative financial structure compared to Nestle. The debt to equity ratio shows the proportion of debt used compared to shareholders' equity. For Dutch Lady, the ratio remains relatively stable, recorded at 1.13 in 2022, slightly increasing to 1.16 in 2023, and then decreasing marginally to 1.14 in 2024. This indicates the balanced capital structure with the controlled use of debt. In contrast, Nestle recorded a much higher debt to equity ratio of 4.67 in 2022, which declined to 4.29 in 2023 before rising sharply to 5.66 in 2024. This shows that Nestle relied heavily on the debt financing. Overall, Dutch Lady maintained a more stable and conservative financial position compared to Nestle. The equity ratios reflect the proportion of assets financed by the shareholders' equity. Dutch Lady recorded an equity ratio of 0.47 in 2022, which slightly decreased to 0.46 in 2023 before increasing to 0.48 in 2024, indicating a strong and improving equity position. On the other hand, Nestle recorded lower equity ratios of 0.18 in 2022, 0.19 in 2023, and 0.15 in 2024, showing higher reliance of liability rather than equity. Overall, Dutch Lady demonstrated stronger financial stability through higher equity financing compared to Nestle. The interest coverage ratio measures a company's ability to meet its interest obligations. Dutch Lady recorded a strong ratio of 15.42 times in 2022, which increased to 22.08 times in 2023, before slightly declining to 19.56 times in 2024. This indicates that Dutch Lady consistently had sufficient earnings to cover interest expense. In contrast, Nestle recorded an interest coverage ratio of 20.07 times in 2022, which decreased to 15.48 times in 2023 and further declined to 9.49 times in 2024. This shows a weakening ability to cover interest costs. Overall, Dutch Lady demonstrates stronger and more stable interest coverage from than Nestle. The debt to capital ratio shows the proportion of debt used in company capital structure. Dutch Lady recorded a low ratio of 0.02 in 2022, which increased to 0.09 in 2023 before declining again to 0.02 in 2024, indicating minimal reliance of debt financing. In contrast, Nestle recorded slightly higher ratios of 0.82 in 2022, 0.81 in 2023, and 0.85 in 2024, showing heavy dependence of debt. Overall, Dutch Lady maintained a more conservative capital structure, while Nestle relied more heavily on borrowed funds.
Recommendation for Dutch Lady Milk Industry Berhad. Firstly, for the recommendation, Dutch Lady should improve liquidity by strengthening cash flow and keeping sufficient liquid asset to meet short-term obligation. Second, they need to enhance inventory and asset management by optimizing inventory level and using their asset more efficiently. Third, to boost profitability, the company should focus on controlling costs and improving product efficiency to increase profit margins. Finally, the study can consider strategic debt using moderate borrowing for growth opportunity without compromising financial stability. For Nestle Malaysia Berhad. Firstly, Nestle should improve liquidity by increasing liquid asset and optimizing short-term financial planning to better meet obligations. Second, they need to strengthen receivable management by improving credit control and collection efficiency, which will help stabilize cash inflows. Third, to sustain profitability, the company should review its costs and operations to maintain healthy profit margins and ensure shareholder value. Finally, Nestle should manage leverage carefully by monitoring debt levels and considering equity financing to reduce financial risk while supporting the growth.
Funding is important to support daily operations, business growth, and long-term sustainability. Dash Lady mainly relies on retained earnings with moderate debts, allowing the company to reinvest in production and product development while managing financial risk. Nestle Malaysia benefits from strong support from its parent company and uses both equity and debt to fund expansion and technology. Overall, both companies have well managed and stable funding structures that help them remain competitive in the Malaysian food and beverage industry.